there's a massive devaluation of the dollar that's going to come in the next 2 years approximately. There's many tools that can show this. I'm going to show you one of the most effective, the Dow Gold Ratio. Basically, the Dow Gold Ratio is the price of the Dow, or the number assigned to the Dow, divided by 1 ounce of gold. I have it up here on the screen. The price of the Dow is indicative of all the money in the economy. You could actually use M2, M3, or those metrics, and they'll tell you the same thing pretty much. You can see there are 4 high points on this chart. I have the chart open. The chart actually goes back to 1915. There should be another high point in 1895, but we won't discuss that because this chart is limited here. You can see the first high point is 1929. Everybody knows what happened in 1929, end of the year, around October. You have the start of the Great Depression. You got the Black Friday, Black Thursdays, where the stock market dropped, major drops. I think it was about 80%. However, 1934, you had the Gold Reserve Act, was put into place. This act devalued the dollar, and it took the price of gold per ounce from $20.67 to $35. This was about a 50% devaluation immediately in the price of the dollar. So whenever this ratio, this Dow Gold Ratio, I figured about 15 to 18. I like the number 18 better. Whenever it goes over 18, there's usually a devaluation. So that was 1929. Stock market dropped in 1929. However, that's kind of separate for the devaluation. But in this case, it added fuel to the fire because, if you had a lot of holdings in the stock market, they dropped and the dollar was revalued. So it's a 1-2 punch. People, a lot of people never recovered after the Great Depression. Was a lot of suicides. But we'll jump forward to the 60s. You can see on this chart, 1960. Let's look for the magic number 18. Occurred about it came about 1962. The 60s was a huge inflationary period. This is when Nixon in August 15th of 1971, he closed the gold window, and with that, he basically allowed gold to float freely, or the dollar to float freely against gold. You had historic inflation in the 60s to the 70s. The price of gold went from, I think 1965, went from $35 an ounce to $850 an ounce. Was the high in 1981. And as you can see, this Dow Gold Ratio was over 18. The stock market didn't drop. I think it went up maybe about 100 points, or maybe 10%. Stayed stagnant a lot of years. However, with the inflation, it was actually about a 40 to 50% decrease, in purchasing power. With the rise of gold and other commodities. Real estate tripled in the 70s. However, gold, silver, you're looking at a increase, is about a 20 times increase from $35 an ounce to $850 an ounce. So this is the second devaluation. So let's go forward again to 1997, to the dot-com bubble. This Dow Gold Ratio went up rather steep, came down rather steep, as opposed to the 60s where, it was a more wide or higher, well, not a higher, but a wider peak. This one is a more sharper, precipitous peak here. So when it went over 18, it moved rather quickly, got to about 40 for the Dow Gold Ratio. You had another devaluation. This time it was in Europe. with the euro. The euro was actually announced, what a lot of people don't know, January 1st, 1999. The euro was announced, and the currencies in Europe, they were revalued in terms of the euro. And they actually got revalued, and they floated over several years. A lot of the currencies, had you initially exchanged, let's say, the Germany currency for euros, you would have got a higher rate in the 99 2000 year than if you would have waited later. A lot of people lost a lot of savings, pensions. People had the ability to convert pensions to euros, and they didn't immediately. They lost money there. Mortgages, a lot of people lost money based on this revaluation of the dollar, or the euro in this case. Now we scroll, forward to 2018. You can see the Dow Gold Ratio was in the 20s here. So this is the fourth time. So we're 3 for 3 so far in terms of a devaluation of some kind. Also in the 90s, gold went from about 250 in 1999, 1997 to 1700 in 2011. So gold, commodities, silver, oil, they always increase with the devaluation of the dollar, or devaluation of the euro, or the currency. And also remember the economists cover in the 80s that had the death, that predicted the death of the dollar, with the phoenix rising from the currencies on the cover. And that year was 2018, and you see the data, the ones and the zeros on the coin, and that can be seen as a representation of Bitcoin or cryptocurrencies. So in my opinion, the dollar is not going to be the main currency. It may be a backup currency, or it may be a currency to buy, let's say bread, milk, basic necessities, until it's phased out. It's going to be devalue more because the debt is too high, a whole bunch of different factors. But this is the Dow Gold Ratio. It means the price of gold is very cheap. Is actually the third, the third most cheapest it's ever been when you look at each segment. This period, it's the third most cheapest it's ever been. So gold is a buy. The dollar, I would get out of dollars, get out of, if you have savings, you want to move to more commodities to protect yourself, because it's been 3 for 3. The next video I'll talk about the S&P, or the PE ratio, and how that ties in. But we have all the factors for a catastrophic event, catastrophic devaluation. It's no different than hurricanes. Let's say a hurricane. For a hurricane to form, you need different components. You need warm water. Water has to be a certain temperature. You need atmosphere has to be a certain temperature. You need speeds going in a certain direction, in a certain speed, for the wind. When all of those things combine, you have a catastrophic hurricane. When you have like 4, 5 different components. The economy is no different. You have multiple components that are flashing red. The one I cover today is the Dow Gold Ratio. In the next couple of days, maybe tomorrow, I'm going to cover a different ratio. And when you take them all as a whole, it means that something big is coming, and the data suggests that this event will come in the next 2 years. So you figure by the end of 2020, the event will have started. So, the dollars start decreasing, commodities start increasing to the level of extent no one knows, but it's coming, soon. So you need to prepare yourself. So hit that subscribe button. More content is coming.